Right now is the exact moment when wealth is made, and I'm going to show you how and where. Right now, everyone's sitting on the sidelines due to interest rates when it comes to real estate. Even though when looking at real estate, today is the perfect time to be buying. Now, maybe not perfect in some ways, but to create wealth, it is. So let's take a look at the data. First of all, the headlines. All the headlines about the crisis in real estate and commercial real estate. And I'm in commercial real estate. I've been in it and we've seen it, and it's hurt. Now, a lot of people may think of commercial real estate as big money, but a huge amount of commercial real estate sells at less than duplexes in most markets. And right now, owners are having trouble selling and are willing to sell at a discount. Yes, when crises are here, it creates an opportunity. But you don't want to buy into a crisis or something that's either getting worse or just beginning. Commercial real estate has been in essentially a recession for almost 3 years now. We've been waiting for a time to enter in, and we've now started allocating tens of millions into commercial real estate. And you can do it with little money or no money. First, let's look at the cycle because it's changing. You see, these cycles go in short and long-term cycles. The business cycle, which creates recessions, is when the central banks are changing the money supply. You see, markets get overheated. So what do? They raise interest rates. That causes the money supply to shrink, therefore stopping things like inflation. This has a very interesting effect on real estate. Now, commercial real estate in particular is much better than, let's say, residential. Why? Because commercial real estate is owned as an asset only, meaning its value comes from its net income. So any changes to that should result in a change in value. And you can measure it. It's much easier to see if you're going to make money or not. And you can spend not a lot of money to do it. Its relationship with interest rates is tied very, very close. When interest rates are low and money is cheap, cap rates go down. What's a cap rate? It's an expression of a return. I'm going to make this easy. If you have $1 million and that property makes $100,000 and you're buying it for $1 million, that's a 10 cap because it makes $100,000 and it cost $1 million. You're getting a 10% return. In its basic sense, to make it easy, that's a cap rate. Now, if I was to buy it at a 5 cap, what would its price be? $2 million. So, cap rates going down actually means values going up. And when cap rates go up, that means values going down. Because a property that makes $100,000 at a 5 cap is worth $2 million. If the cap rate goes up to a 10 cap, that property is worth $1 million. Or it lost $1 million in its price, even though that net income of $100,000 never changed. This is the magic. Intrinsic versus extrinsic value. Intrinsic value is what it gives you when you own it. So if you own it, whether it's worth $1 million or $2 million, it makes $100,000. So its value to me intrinsically is that $100,000 and let's say whatever else I get, like depreciation. Extrinsic is the price on the market, which changes all the time, and it may not have anything to do with the intrinsic value. So why do extrinsic values change? Well, for a lot of reasons. Simply, there's more buyers than there are sellers, or vice versa. But a huge factor is interest rates. Interest rates go up, the cost of capital is more expensive. So I can't pay as much for a property. Therefore, cap rates have to go up to get buyers to buy, meaning the price of the asset has to come down to get buyers to buy, because interest rates are up. It costs them more. Check out this chart. You can see the correlation with interest rates and cap rates. That spread being wider is worse. Now, this is showing an average, but in most third, fourth, fifth tier markets that aren't major big markets, cap rates are much higher than this. We're buying at 8 caps, which 3 years ago would sell for 4 caps or twice the value. This obviously has a huge effect of assets that are on the market for sale. As you can imagine, if the price of the asset goes down, sellers don't want to sell as much because they're not getting as much for selling it. This is perfectly illustrated in this chart. Transaction volume dropped substantially. By 2024, transaction volume had fallen 60%. And depending on which asset class it was, whether that's small apartments, small strip malls, storage facilities, retail, whatever it may be, some of the industries saw a much larger drop in transaction volume. See, here's the truth. The best returns are made when capital is frozen. Your returns go up because capital can't allocate and can't chase assets. Therefore, you're not competing and you're not winning on price. There are no battles for the highest price to win today. In fact, it's opposite. I have not seen an asset in the last 2 years in anything except a first-tier market like Southern California or New York that sold for the price that it went out to the market. In fact, most of them was a reduction of 35%. They may have listed for $1 million, but they sold for $600,000. So that's right. We are now in a buyer's market. In fact, if we just look at the first quarter of 2025, the average CRE deal or commercial real estate had discounts of 20 to 25%. That's average. The discount on its price was 20 to 25% average. That is substantial. And it's getting worse or better for you. Why? You see, over the last 3 years, people didn't sell, right? Because transactions were down, they couldn't get the price they wanted. I don't want to sell at a discount. That only works for so long because sellers don't just sell to get a high price. Sellers sell all day long, every day, for lots of reasons. You have death, you have divorce, you have retirements, you just need your capital out, you don't want to deal with it anymore. There are endless reasons to sell that have nothing to do with the price. You can only hold out for so long. In fact, a lot of sellers are forced. Why? Because they have to refinance, or they have contracts with investors. They just need the capital. So they understand, we're selling this at a massive discount, we're losing money, it just is what it is. And 2025 is the bottom. How do we know? Well, first of all, interest rates have stabilized. And over the last 3 years, we saw that people didn't want to sell. Transaction values are going up. Why? Because sellers are discounting properties. That means assets are starting to move. And this, though, is the trigger. As you can see, 2025 is the year of debt maturities. And it is the mother lode of debt maturities. Hundreds of billions of dollars of commercial real estate are coming due. When we say commercial real estate, people, we're not talking about skyscrapers and malls. Yes, of course, there are some of those. But the vast majority of this is small mom and pop or mid-size assets. And in 2025, they all run into what I call a trigger event, meaning there is something within their deal, their contracts, or otherwise that is triggering an event to happen. That is debt maturities. They are faced with an event, whether they want it or not, it doesn't matter. They have to deal with it. That means we are going to start forcing a lot more sellers to the market, even though sellers have already started to come to the market on their own before we've even hit maturities or peak maturities. Now, not all assets are created equal. You see, some asset classes are collapsing. while others just have weakness or buying opportunities. And this is where we see some asset classes that we love. For example, one of the best parts of rising interest rates and the industry going into a recession is that construction falls off a cliff. As you can see here in this graph, we are now moving into an era of construction starts falling off a cliff. Even in 24 and the start of 25, construction projects that started before interest rates even went up are coming online. But no new ones are getting funded or coming online, and they're being canceled in mass waves. In 2025, we are seeing a steep drop in construction. Why is that a good thing? Because of supply. The less supply you have, the more demand. That means you are buying assets today at a discounted price. The industry can't put new assets out. And in order to build one, that takes years. So even if they started, it would be years until it completed. But interest rates are high, so they're not starting this year, maybe not next year or the year after. That creates mass pent-up demand, which creates higher occupancies and rates, which makes that intrinsic value or the money you make from it go up, therefore increasing value, forcing that value up, whether or not the market's doing anything. Take my portfolio, for example. You see, I have over 3 million net rentable square feet across something like 10 states. We're in Texas, Illinois, Idaho, Oregon, Washington, Nevada, Arizona, Colorado, and on. We're now in the East Coast in South Carolina because we're now buying deals that we're getting great returns. So we started to buy a lot. The last 3 years were rough, and some of our assets got hit hard because right when demand dropped, it hit customers hard because people stopped moving. That means our occupancies went down and rents went down. At the same time, we were trying to fill up some facilities. The perfect storm. It was rough. It's been a hard 3 years. To be honest, most of my competition is gone. Their companies didn't survive. And very few, except well capitalized, big firms are buying deals today. We are lucky enough that we've been around for 20 years, and I went through the Great Recession. So we survived, and now we're taking advantage of it, and we're buying as much as we can. And what we've seen is the last busy season or cycle for our industry, we saw occupancy and rates stabilize, and they're finally ticking upwards. So we've seen a bottom over the last 2 years, consecutive cycles. But that's not all. What is going to fuel or change this? Because it will change, and when it does, it's going to change fast. Why? Right now, there are over $2 trillion sitting in money markets. There is insane amounts of cash sitting on the sidelines. This is just private equity dry powder for CRE. We're at $450 billion plus just sitting there waiting to be allocated. That's not money that's going to be raised. That's not people coming in. It's sitting in bank accounts waiting to buy. Now, I know what you're thinking. Well, I can't compete with that. Actually, you are in the perfect position. When markets are struggling and in trouble, the little guys win. Want to know how? This is how. If you have $300 million and you have to go buy 200 assets that meet certain criteria, there isn't even enough to buy. Plus, high interest rates, you can put that money in a money market account and get a great return for investors because you can't find all those good deals. If you're an owner trying to sell, that means nobody's coming to buy. And those big firms aren't buying in anywhere except first tier and second tier markets. It's not being deployed in smaller markets. So owners in smaller markets, they have no one to sell to. That's why even in mid-sized markets that we're buying in, we're buying at like 8 caps. That's really good considering they were 4 caps just 3 years ago. So for you, this opportunity is once in a generation. And I know I bought through the Great Recession. Owners are willing to seller finance to get out of a deal. You can buy and not even put money down. Or you can buy and put very little money down and the owner will be the bank. You own it and you just pay the owner instead of even needing to get capital. Why would they do that? Because you could either pay them, get a bank loan, and the bank is going to say it's worth $1 million. Or you can go to them and say, you seller finance it and I'll pay you $1.5 million. That's a 50% increase. The bank can't give money because it's at a 7% interest rate. So the owner gets more money, they'll play the bank, and you buy the asset from them and refinance it when conditions are better. Can you do this? Yes, I do this. I've done this a lot. I've done this with $8+ million deals in markets that have 2 million people. After 2008, we did this a lot with owners that couldn't sell because banks didn't lend money. We did this last year and we're still doing it this year. If you are an individual investor with no money, it is the best time to buy. Why? Because you are not competing and owners have no options. The big boys can't deploy the capital. They can't move. They're kind of stuck. So you can come in and negotiate with sellers that have very little options and are willing to do lots of things to accommodate a sell that they will not do when markets are good. When markets are good, people don't sell or finance. When markets are good, everybody can get money. And if you don't have capital or experience, they're not choosing you. So by waiting till markets stabilize, you are waiting till you can't compete and play in the game. And you will have missed a once-in-a-generational opportunity while putting yourself in a position that it becomes much, much more difficult for you to buy and finance. Here's your play. Buy undervalued properties that have been neglected, that the owners would like to sell and get out of. You have upside by turning it around. They can sell or finance it. This is happening in cities all over. You're getting in when prices are down, little options. When $2 trillion comes off the sidelines and $500 billion just for CRE, values will go up. Interest rates go down, capital chases. Your income will have risen because you're turning around that asset. The seller financing it, and all of a sudden the extrinsic value, because now there's lots of buyers, goes up. Increasing that income along with that cap rate going down or that value going up is a wealth explosion. You don't need billions and you don't need to buy a lot. You need one good deal that will set you up for life. So do what others won't. Don't sit around and wait till it's easy, and don't wait till capital markets get better, and don't wait till interest rates come down. Because if you do, you're gonna have a much harder time competing and there's not gonna be good deals. But the number one thing you can do is like and subscribe so that way you can see the conditions and the opportunities and learn more about how to take advantage of them. Like following and seeing our other videos on your buy box, how to know what to buy, when to buy. Don't time markets because nobody can do that. Buy good deals.